Good morning. Bit of a surprise move by the Bank of Canada. They raised rates by 0.25% this morning, which, while there was talk of a potential hike that started to get floated in the last week or two, it certainly wasn't the outcome that was being favored by markets. This continues to be a really difficult central bank and unpredictable central bank. As earlier in the year, if you remember, the last time they raised rates, they stated their intention was to pause, let the impact of higher rates, be felt throughout the economy and see how the data unfolded. That's obviously changed. So what data points came up in the last month that has driven this big reversal? First off, on the inflation front, well, between March and April, instead of inflation dropping from 4.3% in March to 4.1% in April, it actually went up for the first time in 10 months. So inflation went up by 0.1% to 4.4% in April. Obviously 0.1% isn't a big move, but it's all about the direction. It's all about the rate of change. And again, that's the first time inflation's gone up in nearly a year. Now, the irony of that print is the two main factors that drove the increase were higher mortgage interest costs, higher rents. Both those feed back to higher interest rates. So, we have high rates because inflation is high. Inflation is high because we have high interest rates. You can kind of see how it's, this is feeding on itself here. It's interesting to note the bank didn't really change its outlook for CPI. They still expect CPI to fall to 3% this summer. That's the same as last meeting. There's been no change there. So what is the reason for this rate hike today? That seems a little thin if it's all based on inflation. What else happened? On the GDP front, Canada's economy grew by 3.1% in Q1 of this year. But again, you start to peel back the numbers, and almost all of that increase came in January. January, the economy went up by 0.5%, or GDP did by 0.5%. February went up by 0.1%. March went up by 0%. So the economy is decelerating, and I've talked about this before. But if you look at GDP on a per capita basis per Canadian, GDP has been shrinking. We're in a recession. That's a closer reality to what Canadians are facing every day. On the housing price front, prices have been going up, but it's not because we have a healthy, balanced market and strong growing economy. Prices are going up because there is record low, levels of inventory. You limit the supply of something, prices will go up. Demand, for prices to flatten out, demand needs to fall to extraordinarily low levels to match that of supply, or else prices are going to continue to raise here. And it begs the question: how will we get demand to fall as we are, increasing our population by roughly 3% a year right now? There's not enough houses for that to happen. In the bank's financial system review they put out last month, it noted that a third of mortgages have seen payments increase since February of 2022. So you consider that only 30% of Canadians have some form of housing loan, and only a third of those Canadians have seen an increase in payments. So roughly 10% of Canadians have seen a payment increase. So not as much as you would expect, and kind of explains a little bit why there's this massive move up. Why this massive move up in rates hasn't had the impact yet that many, I think, would have expected. Had you told them that a year ago we were going to see this big increase in rates that we've seen here. Make no mistake, the Bank of Canada, they need the economy to break. The move today was worrisome in the fact that this could very well open up the door to some additional rate increases over the summer. On the one hand, more rate increases, this would bring us closer to the point of things breaking and rates eventually coming down. But on the other hand, the question of, how long it's going to take to get there and what's going to happen between now and that point is obviously a big one, and one that we just don't really know. If you're in a variable rate mortgage and you're concerned about this and you don't want to lock in, get in touch with us. You can still get, short-term, like 2-year fixed rates, the low 5% range, 3% rate, 3%, 3-year fixed, close to 5%. We can always secure a rate for 4 months and wait and see what the next few months brings and what those data points, the next Bank of Canada meetings bring in terms of rate hike expectations before you complete on that. But if you do want to look into that, I would suggest getting in touch with me as soon as possible, because we're likely going to see lenders raising rates later on today and throughout this week. That's it for me. If you'd like to chat about any of this, please get in touch. Have a great day.